As 2026 approaches, Europe stands at a crossroads, with its markets bracing for a period of profound transformation and uncertainty. The continent's economic landscape is more intricate than ever, shaped by a tapestry of cultures, regulations, and shifting global dynamics. Investors, policymakers, and business leaders are all asking the same question: what will define success in the coming years? Europe's markets are defined by complexity, not uniformity. Each country, and even each region, brings its own set of challenges and opportunities, making it impossible to paint the continent with a single brushstroke. From the bustling financial hubs of London and Frankfurt to the emerging tech centers in the Nordics and Southern Europe, the diversity is striking. Morgan Stanley has identified 33 critical debates that will shape investment, corporate strategy, and policy across 24 sectors. These debates are not just academic, they are the real-world questions that will determine which companies thrive and which struggle in the years ahead. These debates span everything from the future of digital infrastructure and the resilience of supply chains to the evolution of consumer behavior and the race for technological leadership. Each sector faces its own unique set of pressures and opportunities, demanding a nuanced approach. The era of broad market trends is fading, replaced by divergence, where outcomes hinge on sector and company specifics. No longer can investors rely on a rising tide to lift all boats. Instead, careful analysis and targeted strategies are essential. Long-term shifts like AI, green energy, and geopolitics intersect with classic forces like inflation and central bank policy. The interplay between innovation and tradition is creating new winners and losers, as companies adapt or fail to adapt to a rapidly changing environment. The rise of digital currencies, the push for energy independence, and the ongoing debate over data privacy are just a few of the issues at the forefront. Meanwhile, demographic shifts and labor market changes are forcing companies to rethink their long-term strategies. These debates touch everything from bank loan growth, as financial institutions weigh risk and opportunity in a volatile environment, to industrial competition with China, where European manufacturers must innovate to stay ahead in a global race that is only intensifying. And the impact of carbon regulation, as governments and companies grapple with the urgent need to balance economic growth and environmental responsibility. The transition to a low-carbon economy is not just a policy challenge, it's a fundamental shift that will reshape industries, jobs, and investment priorities across the continent. Success in 2026 will require targeted strategies, not one-size-fits-all approaches. Companies and investors must be agile, informed, and ready to pivot as new information emerges and debates evolve. Let's dive into the most pivotal debates that will define Europe's economic story in the year ahead, and explore how these forces will shape the future of markets, industries, and everyday life across the continent. Europe's 2026 economic outlook is cautious, marked by weak inflation and sluggish growth. The post-pandemic recovery is over. Now, businesses face tougher competition, and policymakers must stimulate activity without reigniting inflation. The European Central Bank is expected to cut rates further, aiming to boost spending and investment. But will lower rates actually spark growth? In a climate of low confidence, the impact may be muted. Companies may hesitate to invest, and households may keep saving. This backdrop sets up a tug-of-war between defensive stocks and those sensitive to economic cycles. The outcome will shape market leadership in 2026. Europe faces a deeper challenge, adapting to a fragmented, multipolar world. The continent's open trade model is under pressure as global powers ramp up industrial subsidies and economic nationalism.
The EU must craft an industrial strategy that supports key sectors without sliding into protectionism. Decisions on public investment and research will determine Europe's global competitiveness.
Regulatory leadership, once a strength, now sparks debate. Is it an advantage or a burden? Striking the right balance between high standards and business-friendly policies is crucial. Europe's response will either unlock growth or risk market share and volatility. The policy choices of 2026 will shape Europe's economic destiny. Artificial intelligence is no longer just a futuristic concept or a distant promise. It has become a powerful, present-day force that is actively reshaping the way businesses operate, governments function, and societies interact. From the boardrooms of multinational corporations to the bustling streets of major cities, AI is now woven into the fabric of daily life, influencing decisions both big and small. The question is no longer if AI will impact our world, but how deeply and in what ways it will transform the landscape across sectors. Companies across Europe are racing to integrate AI into their operations, sparking an unprecedented boom in the construction of data centers. These sprawling facilities, filled with rows of powerful servers, are the backbone of the AI revolution, enabling the processing and storage of vast amounts of data. As demand for AI-driven solutions grows, so too does the need for robust digital infrastructure, leading to significant investments and rapid expansion in this sector.
The debate is intensifying. Will AI finally deliver the productivity and earnings gains that its champions have long predicted? Industry leaders, economists, and policymakers are all weighing in, examining whether the promises of AI will translate into real-world results. Some argue that AI will unlock new levels of efficiency and innovation, while others caution that the path to widespread adoption is fraught with obstacles and uncertainties. For some organizations, AI represents a transformative opportunity, one that could revolutionize business models, streamline operations, and drive profits to new heights. In manufacturing, retail, and healthcare, AI-powered tools are already making a tangible difference, automating complex tasks and providing insights that were previously unimaginable. Yet for others, the journey is far more challenging. High costs, technical hurdles, and integration challenges can quickly erode the potential benefits of AI. Some companies find themselves struggling to keep up with the pace of change, facing mounting expenses and operational headaches as they attempt to modernize their systems.
The impact of AI will not be uniform. Instead, it will create a new landscape of clear winners and losers, as some organizations harness its power to leap ahead, while others fall behind. The ability to adapt, innovate, and execute will determine which companies thrive in this new era. For investors, the challenge is to look past the hype and carefully assess which firms have credible, actionable AI strategies. It's not enough to simply claim an AI advantage. Success will depend on real-world execution, measurable results, and a clear vision for the future. Those who execute well will disrupt entire industries, setting new standards for performance and innovation. Others, unable to overcome the barriers, may find themselves left behind as the pace of change accelerates. As we look ahead to 2026, one thing is clear: critical analysis and strategic thinking will be essential. The coming years will separate the true AI leaders from the laggards, shaping the future of business and investment across Europe and beyond.
European banks are at the heart of 2026's market debates. Optimists see stabilizing economies and lower rates as catalysts for loan growth and earnings. A stable rate environment could ease funding pressures and support credit quality. Skeptics warn that weak growth and cautious consumers will keep credit demand low, limiting banks' upside. Any downturn could trigger defaults and pressure profits.
The sector's performance will be a real-time barometer of Europe's economic health. The outcome will signal the market's direction for the year. For Europe's industrials, China is the defining external force in 2026.
China's policies could stabilize prices, but rising competition in high-tech manufacturing is a bigger threat. Chinese firms are moving up the value chain, challenging Europe's industrial champions. The key question: can European firms defend their margins, or will they be forced into price wars? Specialized, innovative companies may fare better than those in commoditized markets.
The sector's resilience and adaptability will be tested. The China question is now central to Europe's industrial future.
Europe's defense sector is shifting from political promises to real performance in 2026.
Investors now demand proof. Order flow, production capacity, and earnings growth matter more than rhetoric.
Companies with strong backlogs and efficient execution will be rewarded. Those facing supply chain or labor issues may lag, even with higher spending.
The winners will be those who turn government pledges into profitable revenue. Broad sector bets won't work. Detailed company research is essential.
Success depends on operational strength and management's track record.
In 2026, defense is about execution, not just intent. Europe's construction sector stands at a crossroads, facing a pivotal debate that will shape its future for decades to come. Can it truly absorb the mounting costs of ambitious new carbon regulations, or will these changes fundamentally alter the industry's landscape? As governments across the continent push for aggressive climate action, the construction industry is under increasing pressure to adapt, innovate, and invest in cleaner technologies, all while maintaining profitability and competitiveness in a global market.
The introduction of the Carbon Border Adjustment Mechanism, combined with the gradual end of free carbon allowances, is set to significantly raise costs for Europe's cement and steel producers. These industries, which form the backbone of construction, now face the dual challenge of investing in expensive decarbonization technologies while also contending with higher operating expenses. For many, the transition to low-carbon production is not just a technical hurdle, but a financial one that could reshape the entire sector.
The key question for these companies is whether they can successfully pass these increased costs onto their customers, or if they will be forced to absorb them, leading to squeezed profit margins and potential cutbacks. With input prices rising and competition intensifying, the financial health of many firms hangs in the balance. The ability to adapt pricing strategies and maintain customer relationships will be critical in navigating this turbulent period. In a construction market that is already showing signs of weakness, with project delays and reduced demand in some regions, the prospect of further price hikes may be difficult to sustain. Developers and contractors are increasingly cautious, weighing the risks of higher costs against the need to deliver projects on time and within budget. This environment creates uncertainty for everyone involved, from suppliers to end users.
However, there is a silver lining for those willing to lead the way. Early adopters of advanced decarbonization technologies, such as carbon capture, green hydrogen, and electrified processes, may gain a significant competitive edge. These innovators can not only reduce their regulatory burden, but also position themselves as preferred partners for environmentally conscious clients. On the other hand, companies that lag behind risk severe margin pressure, loss of market share, and even regulatory penalties.
As a result, the sector is likely to see a clear and growing split between forward-thinking innovators and those slow to adapt. The gap between leaders and laggards will widen, with the most agile companies reaping the rewards of early investment, while others struggle to keep pace with regulatory and market demands. Ultimately, the ongoing carbon debate will define the winners and losers in Europe's green transition. The choices made today, by policymakers, industry leaders, and investors, will determine who thrives and who falls behind as the continent moves toward a more sustainable, but undeniably more costly, future. For investors, the challenge is to carefully weigh regulatory risks against the potential for market growth and innovation. Those who can identify the companies best positioned to adapt will be well placed to benefit from the transformation of Europe's construction sector. Europe's 2026 market won't be defined by a single story, but by dispersion. Broad trends will give way to sector and company-specific outcomes. Defensive and cyclical stocks will battle for leadership, with no clear winner. Policy, AI, and global competition will create distinct opportunities and risks. Success will come from granular analysis, not broad bets. Investors must dig deep, understanding loan growth, Chinese competition, defense execution, and carbon costs. Morgan Stanley calls this a market for idiosyncratic alpha, returns driven by unique factors, not the market tide. In 2026, Europe's story will be written in the details of company and sector performance.